Okay, guys, I'm happy to introduce our guest speaker tonight, all the way from Vernon, but he's done deals all over the country. We had a great dinner tonight before the meeting. Nice to meet in person because we hadn't actually met in person before the podcast, if you watched that. But just off the top of my head, Jon Simcoe has raised over $30 million in private equity. And a lot of it's been RRSP money or registered money of some sorts. We talked about Lyra's a little bit earlier in the room here. And yeah, Jon has done in excess of 150 rent-to-own deals, right? Is that right? Yeah. And yeah, big track record. We went into detail on it, on his personal life on the podcast, so I'm not going to rehash that here. But yeah, super excited to learn about how we can use more registered funds for our real estate business. And yeah, welcome, Jon.
Thank you, Sam. Let's give a big round of applause to Sam for organizing this, because it's a lot of work to put these on, remind people that it's happening, plan things out, contact speakers from out of town. Let's thank Sam for putting this room together. So I'm really excited to be able to share with you guys a lot about RRSPs. And so in this presentation, we're going to cover a few things. We're going to learn, I'm going to go into a little bit greater detail about like where I came from, how I learned about this, as well as how you can use RRSP mortgages for your deals. We're going to cover a lot of the lending side. There's a couple sides to this, so tonight we have time to cover the lending side. If I had more time, and also I've got some videos online that you'll be able to get access to that are also about the borrowing side. And the borrowing side is when we're making deals together. And so I'm going to share with you guys a presentation that I use that raises other people's RSP money, teaches a little bit of the do's and don'ts and how it works, what the rules are, and that's what we're going to have time to cover tonight. We'll also have some time for some questions as well. And if anybody has a deal they're working on, I'm more than happy to, on the spot, crunch some numbers to see whether RRSP financing can be used on it, whether it's a good idea, whether it's a good place to get that money from, or whether you need a better deal. Because there's many ways to finance, refinance any property, and this is probably one of the most easiest, flexible ways you could ever do so. So as Sam said, my name is Jon Simcoe. I've been investing in real estate for the last 13 years. I've raised just over $33 million in private capital to be able to do deals. I've done over 150 rent-to-own deals. One of the things that really propelled me onto the scene was I quit my job 5 years ago, as you're going to learn. And one of the ways was doing rent-to-own. I've really got two main tricks that I'm good at, and I just do them over and over and over. I'm not an expert at everything. If you want to learn about apartment buildings, Ken Beaton's coming in January. I'm not the guy. I don't own any apartment buildings. But if you want to learn how to get as many houses and other properties as you want, I do know how to do that, whether you're doing it for fix and flip, for rent to own, for buy and hold, for buy, renovate, rent out strategies. All of those are applicable and can be done with these RRSP mortgages. So if that's a strategy you're doing, you want to pay very close attention to this presentation. So I'm going to tell you guys a few stories about my past, and this is before I've been nominated as Canadian Real Estate Wealth Magazine's Joint Venture of the Year Award 2015, 16, and 17, and they called me yesterday. I might be up for another award for this next year, so we'll see where that goes out in Toronto. So that's the, you get to get that finalist. I never won it, but it just means that I've done a lot of joint ventures with other people, because together we can accomplish more than apart. Also, this is related to this talk today. There's the issue of Canadian Real Estate Wealth magazine, the Quit Your Day Job issue. This is from last year in August of 2017, and that's actually my cover story. So I am the Quit Your Day Job, and at first I told them, well, I did quit my day job by doing a bunch of rent-to-owns, but, and they said, well, somebody else is already writing a rent-to-own article in our issue, so we don't need you. And I said, wait, don't hang up, because this is free publicity. If you ever get a chance to write for a magazine or for a blog post or something, take it, because it really makes you look good. And I said, well, I got this other thing that I did enough times you could also quit your day job with. Why don't I write an article about that? And that's about the RRSP mortgages we're going to learn about today. And so,
what was that again?
August of 2017. I also have I'm a best-selling author on Amazon. This is the Rent-Own Solution to Home Ownership book, and that came out in 2016 as well. I've also won a Most Capital Raised award. I belong to a coaching and mentoring program. Out of all the students, I raised the most money. I think at the time it was about 16 million or 12 million and around there. So it was a few years ago. I won the award out of all the students, as well as the Rent-to-Own All-Star Award. So I've won and more awards since then. But it's just, there's a time when you learn how to run really good at this, and this is something I really know a lot about. But the story I'm going to share with you is about before I learned about it, and you might relate a lot to it, because if you haven't learned all about it right now, then it's going to be new to you, just like it was for me then. So most of the time when we have, like, who in the room has an RRSP or a LIRA account? So almost everyone. And I think it's hard to find circles where someone doesn't have at least some money in their account like that. And so when we have an account like that, we're planning to have income in our retirements. Often we want to be able to, leave a legacy. And of course you can have lifestyle. So when you're retired, a lot of people want to go on trips and have fun. That's not the focus of today's talk. Today's talk is going to be focused mainly on growth as well as leaving a legacy. And by legacy, imagine that you're super rich and wealthy and you're passing away and you want your name to go on forever. You might donate some money to a charity, or you might create something like an endowment fund in your name. Maybe it's maybe you give a $1,000 scholarship to some student every year. The fund grows enough to always be able to give that $1,000 out. You can leave a legacy if you can create enough wealth in your life. So those are some of the reasons why you might want to be able to do this, and you might want to have your RRSP account growing. So I really got my start when I was working in Winnipeg. I was going to university to be an architect, and I got out of architect school one summer. I worked really hard. I always had minimal student debt. This is a $20,000 a year program that I did for 5 years. So $100,000. I worked hard every summer, 2 or 3 jobs to have as little student debt as possible. And that was just meant that when I finished, I had a smaller loan than people who just didn't work 2 jobs in the summer. They went further and further into debt each year. So the first summer I got out of university, I paid off all my student debt by working long hours. I've worked on farms in Manitoba, grew up in the country in the rural areas, done plenty of landscaping work, I've cut plenty of lawns, I've worked as a garbage man in the summertime, so I've gotten down and dirty before, and I know what it's like to work with my hands. And so I always worked really hard, and so the first summer I got out of university, I paid off all my student debt, and I bought my first rental property. So it was a very exciting time. I was 23 years old, and decided that this is what I'm gonna do. So myself and a friend, we bought that, and we renovated it, we rented it out for 3 years, and we did what any 26-year-old pair of guys, I actually saw that friend of mine yesterday of all things, that same friend, because he lives in the area. But we went out and did what responsible 26-year-olds do. We go buy Porsches and Dodge Vipers with our house profits that we made. So it's like getting a big windfall of money. I've done that once. I know what it's like to win the lottery, and I decided I wanted to do more real estate deals at that point. So after having that first house, I decided that what is impacting my own income and ability to save up down payments? Because I thought I needed to work hard and save up like 20% down to buy every property. And so what I learned was that the more I could do with it, with you know, if I just decided, and this is just at that time, now I know differently, but at that time, like over a decade ago, I thought, well, the harder I work per hour and the highest rate per hour that I can earn will determine my income, you know? So I used to work when I was a student a lot of hours for medium to little pay. And I thought, now that I don't need to work like that anymore, and I've worked 15 hours a day, 16, it was no problem. So I decided I'd go out to Fort McMurray, leave everything I had behind, and I would go get a high-paying oil job where you can work for 12 hours a day and they'll pay you overtime and they'll give you $30 and $40 an hour plus. And so I thought I'd fill my days with as many high-paid hours as possible, and that I would save all that money, and that would turn into more properties. Because I really, the end goal was always to get more properties. So I decided to work long hours, desperately wanted to buy another rental property. So I also followed the advice of my father, and who's rich dad, poor dad in the room? Most. If you haven't, you really need to. But in Rich Dad, Poor Dad, the type of household that I grew up in is more like the poor dad mentality. I'm not saying that we're poor, but the mindset isn't the same. It's go to work, get a good job, have a good pension. And you won't really get rich that way, but you can be comfortable. And so my father said, oh my God, you're going up to drive those big trucks up in Fort McMurray. You're not being an architect like you're supposed to. You know, I'm kind of letting him down a bit. And he said, well, John, you gotta at least max out, you have enough money coming in, you gotta max out your contribution room from your RRSPs. And if you do that your whole life, you'll be fine. So that's the advice that my dad gave me. And so I started, you know, I didn't have spare money when I was a student to buy RRSPs, but I was working. So I got to buy back my old contribution room. And so I sweated for that money. I worked extra overtime, did it all in the oil patch, and bought a bunch of extra RRSPs. And I did a little bit of math, and after doing that for a couple years, and buying back all my contribution room, I looked at, you know, you can put about at the time you could put about $18,000 as your maximum each year away. And so I figured, well, if I did that with my after tax, you get taxed like at about 50% on those wages in Fort Mac. So you could pay $100,000 in taxes just in 1 year. And so, you know, if you have 80 or 100 left and you put 20 away, and you got to pay for your housing, and you got to pay for your groceries, and I still was driving my university Honda for quite a few years before going to get the Porsche, but kept living modestly and saving. And I figured that if I was going to have 20% down to put on a property, it's going to take me a heck of a lot of time if I'm trying to max this RSP out and save 20% down. That I could only get a new house every year or two, depending on if, you know, I could get a house in Winnipeg, where I was from, each year if I maintained that path, I might save $40,000 extra and go buy a $200,000 house. But that's still one house in 1 year. And it's actually a slow way to grow. It's very laborious, it occupies all your time, all of it. But I first started out by following that advice of my father. And so I'd be saving all this money from these paychecks of mine, and guess what happens? Who's had a bit of money in their account, and they go in and they talk to the teller at the bank? What does the teller say?
You want to sit down with someone?
Yeah, do you want to sit down with some? Maybe you'd like to talk to a financial advisor. Who's been to one of those meetings? Yeah, I did. I think almost anyone with an RSP account at some point has been called into their financial advisor's office, or at least offered to, so that they could make some investment decisions. And so that's exactly what they said to me when I walked in. And so I went in and I put some money that was to max out my RSP, and I thought, well, I was saving up money for a down payment. I might as well invest that outside my RSP, and when I'm ready, when it grows a bit more, it should make the amount of hours I need to work a little bit less if my money's working for me and I'm working for me, all towards a down payment being the goal. So one of the things that you go and you see your financial advisor, and you go see your financial advisor, and what are some of the things that you can invest your RRSP into? So GIC, mutual funds.
Don't forget that 2.5% MUR.
Front load.
Oh yeah. Yeah, we're gonna talk about that. So I'll just write MER, and those who don't know, we'll get to it. What other types of investments are eligible for an RRSP to make?
Stocks.
Stocks, yeah.
Bonds,
Bonds,
ETFs.
stocks, I'm just gonna put a little hyphen ETF. That's an electronically traded fund? Exchange traded fund. It's more based on a stock index. We're not gonna get too much into it tonight, but typically they've done a little better than mutual funds in the past. There's less fees. The fees can have a huge impact on your final results. Anything else that we can invest into with our RRSP?
Real estate.
Oh, you can do real estate. And there's two ways you can do real estate. One is with the way I'm gonna teach you tonight. The other way is if you have like an eligible, maybe a medium-sized investment company, they might sell you some shares that are RSP eligible. And so you could have a share, a piece of that real estate, or you can invest directly into the real estate. There's two ways. And the other way, I'll do it, is you can also do gold and silver. So gold and silver, but you're buying the certificates. You're not buying the physical gold and silver. You don't get to hold it, but the bank gives you a piece of paper and says, this is worth 1 ounce of gold. And when you go to sell it, whatever the price for an ounce of gold is what you get. So back then I went to go see the financial advisor, and I went and found an old statement of mine from back then. I still have everything in my filing cabinet for many years. And when I was making this presentation, I said, well, I remember things being pretty rotten back then. So we get a chart like this. I remember going in there, I'm probably like 24, 25 years old, and I have one rental property. I don't know if I'm gonna do more or not. I'm figuring out, am I gonna invest in stocks? How am I gonna grow this money? And they show me this here, that we have this $10,000 investment, and over the course of about 30 years, turns into $86,000 on this chart. And so if I had invested a long time ago, it would go up to there. So if I invest there today, it should go up to there. It should, it makes sense. Like, they're telling me here that I have this is based on 3-year standard deviation. I'm a big math nerd, but does anyone have an easy explanation of what standard deviation is?
Is that the average? The mean? No?
There's a lot more to it. So you're basing this whole chart on something that you don't even understand, standard deviation. So they show you this, and all you can really figure out is that if you bought here and you sold there, you make some money. So you might as well get in. Seems like a good idea. Let's invest. I'm pretty confused when I go see him, but that's what I thought. That's how I'm gonna make some money in the meantime. So this is for that index fund comment.
Ouch.
Yeah. So, sure.
We'll send you a copy of the slides.
Yeah. I'll be recorded.
Yeah. That's exactly what it is.
Mm-hmm.
Let's add, cream another 2% off you.
That's okay. So, I wanted to ask you guys, so someone mentioned MER fee when we were talking about mutual funds. They're like, oh no, except for that 3% MER fee. Does anyone know what an MER fee is? Management expense ratio. Does anyone want to explain what it does?
Covers the cost of managing the fund as well as advertising and promotion.
Yeah. So the person who manages the fund gets paid a piece of that. The person in the bank, like the financial advisor, I like to call them financial salespeople. I don't know if they're really an advisor, but they're there to sell you on a fund to go put your money in. Typically, if you go to, and I'm not picking on any of the banks, but if you go to a TD bank and you meet with a TD advisor, they're going to tell you to buy TD stock or a fund managed by a TD manager. If you go to Scotia, they promote their own, rather than giving you the advice that's best in your interest of which one might grow the most. They're more concerned with how much are they going to make. So the average Canadian, and most of the people out there, if you're approaching somebody to do an RRSP mortgage with you, expect most of the time they're going to tell you that they are in a mutual fund, because that is what most average people are in. And a mutual fund is just a collection of stocks. You could pick all those same stocks on your own and avoid paying that fee, but they want to make it nice and easy. And that fee can be huge. So if you have $100,000 and it's growing at 6%, but then the MER fee of 3% comes in, you're only going to earn 3% that year. So instead of earning 6, you earn 3. What that fee is actually doing is, instead of making $6,000, you're making $3,000. Your earning has been cut in half by that fee. And every fund has a different rate of growth, and every fund or loss, and every fund has a different MER fee. So they're not all created equal. They're confusing as hell, just like that chart is. But after fees, what does the average Canadian, what is the best results? So I'm looking for the average of the top 10 mutual funds. So the best performing mutual funds in all of Canada, what are the after fees return? Because they can tell you 10%, but when you
8%.
add that MER, it goes down.
8%.
8%. So after fees, we have 8%. Who thinks it's
1.5.
higher?
I think it's 6.
6. This is the best, remember? You don't think it could be 10?
No.
After fees, the best funds.
No,
You need like 100 grand just to get into it. They don't even offer it to you off the street. Lower than 6? The best performing mutual funds after fees.
I'll guess 9%.
9?
I guess 4%.
I was gonna say
Four?
4.
My guess is
4.
Okay.
I heard 1.5.
Anyone
I said
think lower
1.
than 4?
I said 1.5.
Okay, I'll just put lower. So let's do a show of hands. Who thinks, after all fees are paid, the best performing top 10 funds in the country, who thinks 9%?
For all 10 or the top?
Just the average of the top 10, the best funds in Canada.
But what are they investing in though? Canadian stocks?
Yeah, how risky?
Or
Maybe
international or what?
One year went to the other year and they got a higher return than the other guys, regardless of what they bought. Doesn't matter what's inside the mutual fund, how did the fund perform? So 9%, we had 1, 2 people. Who thinks it's 8? 1, 2,
What year?
6?
It's always
Just in the last year.
6.
This is questions from a year ago. 6? We have how many? 1, 2, 3, 4, 5, 6, 7? What about 4? 1, 2, 3, 4. And who thinks lower than 4?
No, I do.
Yeah.
Lowest is not
Well, if we're playing with price of right rules, that might not be a bad one to hedge your bets with, because you got a good spread. So the average of the top 10, and remember, you need about 100 to about $250,000 just to be asked to put your money in these funds. So they're not accessible to the everyday Canadian. But the average is 6.1.
Huh,
That's of the best.
pretty high, actually.
Yeah.
Well, this is the best. This is the best that you're gonna do in mutual funds, and let's be honest, most people that you meet
Start at 100?
are not in the
100
best.
grand.
Wow.
Most people that you meet are getting less. My deal that's going through tomorrow, and I love this, one of the guys contributing money to it is an actual investment banker. He's not investing in his own bank's product because he learned about this and now he's doing RRSP mortgages. And when I asked him, what are you getting with all your wisdom, with all your bank tools, what's your account growing by? He said 5. And he was like, I work it hard and I move it around, and 5.1 or something like that. And I'm like, wow. Well, he's getting 8 with me, so that's like over 30% better results just to change.
Diversify, right?
Yeah, and so if you're looking for money, either to put your money into a real estate deal or looking for money to get into your real estate deal, keep this number in mind, because that's what most people are getting less than. And if you're like most people and have RSPs and they're in mutual funds, you're probably getting less than that. It might say 8 on your return sheet, but after all your fees, it's going to be less. So here are the results. This, of course, is 2008. Great time to be getting into the markets. But here are this is the actual statement of my account at the time when I just started putting money aside. And if you pay attention over there, you can see the results of it. Don't look too closely at my statements. That's my financials. But I do want to really, really highlight these phenomenal returns. This is what happened to me my first year investing in mutual funds.
See, I was right.
I was in 2 different funds, yeah. Negative 33% for one fund, negative 16 on another.
That was the crash.
Well, yeah.
That's what happened to everybody who invested in cannabis too. Everybody's like, oh yeah, it's going, and then November or October 17th.
And who's got a real business behind them, or cashing in on hype? And so I mean that really hurt. And at the time I was like quite angry with the financial sales lady, and she used a line on me, and I remember it. She used this line. She said, when I was getting into it, I said, well, is that a good one? And she says, well, John, it's the one I put all my family members into. And if it's good enough for family, it should be good enough for you. And I was like, oh, okay, great. I just totally bought into it. Well, I was confused. I didn't know what to do. And most people, when they go invest in their RSPs, they really don't know what they're doing. And it's okay to admit it. But this was the wake-up call that caused me to learn about RRSP mortgages. I was reading a lot of books on real estate, learning how can I get more properties during that time of my life, listening to audios while I'm driving around that big truck, and podcasts, like the one Sam puts out. I listened to that type of material. I said, I just figured that there had to be a better way. And guess what? The funds still charged fees after that. They get paid whether your account goes up or down. They still get their fee. Doesn't matter. And that's when I figured there's got to be a better way. There are some people who do make money in real estate and do make money with their RRSPs, but they're doing something different than me, because my results suck. Well, they did. So here's where we go through some of the different things that we could put our money into. We have our GIC. GIC stands for little to no growth. Inflation is like 3%. It's even higher if you're adding more categories that they keep not adding in the calculation. And if you're growing by 1% or less, you're not keeping up with inflation. That's why they say savers are losers. And then I have down here the stock market. You can do stock market as well. Here are those famous bonds. And what happened a year ago? The end of the Canadian bonds. They do not offer them anymore. It was deemed that less than 1% of the Canadian population owned Canadian bonds. And so the government said it's too much money to do the accounting on this, we're just not going to offer it anymore. And so they shut down the Canadian bonds. So that's actually no more. It was mostly grandmas and grandpas that would buy it, give it to their kid, and wait a period of time, and it's, you know, they can't go spend it on something. And then when they're older, they can take it out and have some money for a car or a school or a first house or something. That's usually the people who bought them, and it was mainly because most Canadians find better returns doing other things. They're getting better returns in most of their mutual funds, unless they're losing. So mutual funds were taking all the bonds money. Now, versus a physical asset, like silver and gold is physical, you can hold it, you know. Believe it or not, you can actually put the money into a house, a physical house. There's sticks and stones. These are just paper assets. It's just a piece of paper that says you have something. You know, more real estate and equipment. Equipment can be a physical thing to invest in.
Registered funds in equipment.
Not registered funds, but just the physical and on. So that's maybe not for RRSPs, but it's an example of something physical. If you put the machine to work, it can generate money.
You could loan on a small business, couldn't you? I forget. Maybe not.
Yes and no. For today, we're gonna say no. I'm working to crack that code. I got some ideas. So we're gonna shift gears a little bit, and instead of talking about RRSPs, we're gonna talk a little bit about mortgages. So does everyone in the room know about what a mortgage is?
Mm-hmm.
And where do we get our mortgages most of the time? The bank? Our mortgage broker that calls a bank? That's usually that's where they come from. And so mortgages are literally the bread and butter of bank investing. You know, they're big, tall, fancy buildings, the lavish offices are all paid for by mortgage lending. So the bank, you know, they might make some money from lines of credit and a little bit other money from auto loans and things like that. But their bread and butter is when they're writing a $300,000 mortgage, a $400,000 mortgage, that's where the bank's bread and butter is. And so over 75% of the bank's income are typically from mortgages. And banks do consider it to be very, very secure, and that's why they do a lot of it. Canadians typically pay their mortgages on time. You know, most of us would eat Kraft dinner to be able to make our next mortgage payment versus, you know, eating at Red Lobster every night and then missing it. Canadians just aren't wired that way. We're wired to pay our mortgages on time. What the banks like is that these mortgages are secured by a physical asset. The bank doesn't invest its own money into mutual funds. You notice that? They'll sell you on it. They want to make fees on it. But the bank really invests in mortgages mostly. And what happens if you don't pay your mortgage?
They take your house.
Yeah, they come take your house and they sell it and they get their money back either way. And then they go out and they're just in the business of lending. 99.9% of mortgages lent out, including RRSP mortgages, work out exactly as planned. People make the payments on time, and it works out. There may be foreclosure rates that climb in lower, but they're typically very low compared to all the people who are above board with their mortgages. And in the times they don't, there's a physical asset that can be taken. So banks consider it to be extremely secure, a very secure form of their type of lending. And of course, if the person doesn't pay, even if it's an RRSP mortgage or a bank mortgage, an RSP, even if it's a bank mortgage or an RSP mortgage, the lender who lends, if they're not prepaid back on time, can still go take the asset and then sell it and recoup their money. So it's still, most of the time they work out just as planned, but if you need to, you can take that physical piece of property. So you can turn an RRSP into a mortgage the same way that the banks create mortgages. Whose first time is it hearing about this? Like, because I don't think many people know about it, because the banks don't really want you to know about them, because they want you to buy mutual funds at their bank. They don't really want you to know that you can do an RRSP mortgage with each other, or with me, or with Sam.
Well, you haven't really defined what an RRSP mortgage is, so I remember back you could take your RRSPs and use it as a down payment, but then they wouldn't grow as long as there's a debt on it, so it's your money's stale, right?
And that's worth bringing up. There's a lot of RRSP plans out there, and there's a lot of ways, but that's typically a first-time home buyer where they're able to tax-free take their RRSP out and buy their own first house with it. This is completely different. This is where one person is lending their RRSP to another person. So you're not using your own RRSPs for your own deal. In fact, in these RRSP deals, they need to be at arm's length. And arm's length is defined as somebody who is not your mother, your father, your brother, your sister. Aunts and uncles are cool. Cousins are okay.
Is there a broker then, or?
No, just two people. So I'm not related to Sam, surprise. You know, we're not blood related, we're not family name related. It includes adopted kids though too. If you adopt a kid, you can't do these deals with the adopted kid. But we don't know each other, and so we're actually gonna go into a thing. It's the main reason they don't want you to know about it is because they want you to invest in their own products. And there's very little RRSP mortgage information out there. Because an RRSP account is gonna get to grow by whatever rate that mortgage is. And you can do a heck of a lot better than what the mutual funds are doing, with a heck of a lot less risk. So I am going to get you guys to do something, and that is go on your smartphones. I'm gonna give you guys something I created a long time ago, an audio CD, and I called it RRSPs into Real Estate. So go on your phone, go to jonsimcoe.com, put the www in there, it needs that. jonsimcoe.com. Scroll to the very bottom of the page. So www.jon, there's no H, Simcoe, SIMCOE.com. Just go all the way to the bottom of the page, and where it says Deal Flow Monthly, I want you guys to subscribe with your email address to my newsletter, and then I will turn around and give you guys the audio. I've sold over 1,000 of these audios at $30 a piece over the years of doing different presentations, just trying to get the word about RRSP mortgages out. And so some of the further learning, I'm gonna add you to this RRSP into Real Estate little mini program that I have, where you can learn a lot more about RRSP mortgages and the rules after you're done leaving the room here. So this is, when I see that anyone who's signed up to the newsletter tonight, I will manually go in and give you access to this, and then it's up to you to learn what you want from there. And at that point, if you want to talk some more about it, I actually do not, like, if everyone's going out to grab a bite to eat after, I'll come join you guys. If not, that's cool. but I will not have an in-depth conversation about these RSP mortgages until after you've gone through that. Because literally, it's about an hour long to go through that, and it's gonna answer every question you're gonna ask me. And if I have this conversation with everyone in here, it's gonna take 2 whole days for me to do what has already been created. So I've just duplicated myself on that. And after you're done learning about that, the conversation we have will be much more in depth, much greater. The questions you ask will be smarter, they'll be more relevant. So I do not answer a ton of questions right after the presentation. We'll do it, but when we're in the social setting, I'm gonna tell you, you're gonna ask me the same questions that are in there, so just go on into there. So here's the structure. So, Ryan, come on up.
So good.
Yeah, well, we were just talking in the back, so we got to know each other a little bit, and now we're friends. All right? And so, Ryan, you got some RSPs, right? Yeah, and your role in this little role play is that you want to be able to grow your RSPs using an RRSP mortgage. You've learned that they're very secure, and you've learned that they're very predictable. And so you've decided to work with a professional like me, or like anyone else here who has more than one property, is, got some real estate experience under their belt. I recommend working with someone experienced for doing this, but it's also not too hard to set up. They're actually very easy. And so you're going to be putting your RSP into one of my deals. What I am not asking you to do, Ryan, is I am not asking you to withdraw your RSP and give it to me. If you withdraw your RSP, what happens?
Then you take your hit.
Yeah, you take a tax hit. So Ryan's talking about you have to pay tax. If you withdraw money from your RSP, you have to pay taxes. And so we're going to be keeping it registered. So any growth that occurs in this real estate deal is going to grow tax-free in your registered account. Tax deferred, yes.
Don't
Well,
worry,
it's
I got
true.
your back, I got your back.
No, thank you.
Yeah.
That's very
Watching out
true.
for the fine print.
Yeah. And so
Tax
we
deferred.
you do have to pay tax on it 1 day later, and they say, like, when you talk to a farmer and you ask him, would you like to pay tax on your seed or would you like to pay tax on your crop? That's really the difference between RSP. If you're not investing through your RSP, you're paying tax on your seed. If you are going through your RSP, you're paying tax on the final result. So there's only a few places in Canada that we can actually use your RSPs to create an RSP mortgage. All of my experience for all my deals but one have been with a place called Olympia Trust. It doesn't show up very good. But Ryan, you're going to create a self-directed account at Olympia Trust. Self-directed means that you're the one in control. You make your own decisions about how your RSP is going to be lent out and what it's going to be doing. It also means that you don't have a manager who's managing it, which means no MER fees, very low account fees at Olympia Trust. And so Olympia Trust is going to act in between us, so that they will hold your self-directed RSP account. You still make the decisions about what happens. And so what's going to happen after that is, in order to turn this money into a mortgage, we need a lawyer to create a mortgage document. So the lawyer creates the mortgage document the same way that they're going to create and register if a bank was lending a mortgage. They're going to create, all that fine print, and it turns into a mortgage document. After that, there's going to be a deal. So there's a house, and that house is going to be securing your money. It's really just the lawyers that, we're going to give them the instructions about that. So as much as these RSP mortgages are negotiable, I can say I'll give you 6, you say I want 7, we can go back and forth. When I do my business, I just usually offer the best I can. It's the reputation I have of being generous and paying people a little more than maybe I could have got it for, but it's because I'm trying to share the wealth. And when this house sells, when this deal is done, I want you to do another deal with me. So we do negotiate the terms between us, such as the lending rate, the percentage that it's gonna be at, when is it gonna be all paid back, how often are payments. Payments can be once per year, they can be monthly. The RRSP mortgage I'm getting tomorrow, I don't need to make payment on it for a whole year. And I'm gonna make the place a lot nicer and sell it in that time, and I'm planning to have it sold before even the first payment is due. 9 months from now, I wanna be done that deal before the 12-month anniversary. And if not, then I have to make that payment. So, thank you, Ryan.
Glad to help.
Yeah.
Thanks, Brian.
So one of the things about it is that Ryan is going to be able to earn a set rate. Most of the deals I put together are in the 7 to 10% range. I really pride myself on outperforming these guys here. This is my competition, and even giving someone an 8% amount is a heck of a lot better and a lot more certain than a fluctuating market. And so what I like about RRSPs is they remove the emotion. People think you need to time the market to do it right. And often people let their emotions get in the way, they time it wrong. Oh, everyone's selling, the market's crashing, it's time to sell. Well, now you just sold when it was low because you let your emotions affect you. Or everyone's getting in, let's get in too. Oh, everyone's buying cannabis stocks, and let's all buy them. It seems like a no-brainer. So there's all this, you know, this is it's from that Tony Robbins book, Money, that I got this image from.
Yeah.
And it's the excitement. Point of maximum financial risk is optimism, excitement, thrill, euphoria. Oh no, this might not be working. Anxiety, I'm nervous. Denial, fear, desperation, panic, all the way down to depression. Oh my God! And then most people are selling at some point lower than they bought, and they're letting their emotions control them. With an RRSP mortgage, you don't need to have all the fluctuations of the ups and downs. There's no emotional roller coaster. You know, if you're getting 8%, that's how much yours is going to grow by. You can put it in a spreadsheet. You can see what next year, the year after that. You can actually pre-calculate what your retirement amount will be. It's not exciting, but investing is not supposed to be exciting. There's not supposed to be a big roller coaster. It should be based on fundamentals. Like I said, predictable growth. Regardless of if the market's going up or down, I have to make a payment to Ryan or I'll lose the house. And I'm not gonna lose a whole deal just because I missed one payment. So payments are gonna come in, I'll eat craft dinner if I have to, and you can just predict exactly how much will be there the next year, the year after, the year after. And that's what I like so much about RRSP mortgages. So after that crash, I went and put my money and I invested it and lent it to another real estate investor that I know that had 22 houses. They were experienced. My money's been working with them ever since. I've never changed it. And it grows every single year instead of this fluctuating market. It works better for me, and I'm getting a much better return than any of these guys. So it's a true set it and forget it strategy. You can set this up for 5 years and you don't have to touch it again for 5 years. You'll know what'll be there and that's what'll show up. You can do it every year if you want to. There's some people that get into a new deal with me every year and I pay them off, like the one that I'm closing on tomorrow. 9 months from now, when that place is sold, those people will get fully paid back, and guess what? They're gonna wanna lend again. So if you treat people right, they're gonna wanna always be lending to you. So I wanted to share one little thing here. Actually, we'll skip over this, sorry guys. So once again, just to recap, that you can go out and use somebody else's RRSP money and you can apply it to either a purchase, a refinance. You can do anything flexible with it. You can go all the way up to 100% loan to value doing this. And I don't always think that's a good idea, but like for example, I found an $800,000 house for $650,000. I'm okay financing all $650,000 of it because I still have extra equity in there. And if the lender has to come take it from me, they can still sell it for more. It also outperforms most other RRSP strategies. The only people who defeat me on this point is the people who are day traders. who are literally like in there all the time, and some of them can have some pretty good results with what they're doing, but it's still risky. You're in and you're out, and things can happen. And it's truly not, it's more active, whereas this is something that once you've signed your papers and it's put into the deal, you don't have to think about. So that, you know, you might do a little better day trading, but it's still risky in my eyes, and it's a heck of a lot more work. This is easy. You know, you no longer need to dread opening your statements. I used to, when that market was crashing, I didn't want to open those envelopes. You know, you don't need to time the market. And it does take the emotion out of decision making. You can make it based on fundamentals. We all know real estate fundamentals from being part of this group. So this is the little program that I'm gonna give you guys. It's the $30 package. It's the RSPs into real estate, so you can learn more about it. There's a lot more like do's and don'ts, things that need to be at arm's length. We covered some of those things today, but I made a very simple little program that you can follow along, where I just go through it's strictly the nitty-gritty details, and I believe that you guys will all enjoy it. So as long as you've signed up for the newsletter, what I'll do is tomorrow I'll manually add your email address that I see. You'll send me an email saying, you know, Ryan signed up for the newsletter. I'll just go and add it to this here. You'll get a request to make a password, and then you can log in and see all the content. So make sure that you guys have signed up for Deal Flow Monthly. That's at the bottom of jonsimcoe.com. So it is 9 o'clock, so I'm pretty much out of time. If you guys also want to know as well, not only about the details about how to lend in great detail, but I do also teach a higher priced version, which I sell for $9.97, and I guarantee that you'll get a deal with it, and I'll help you through it. If you're working with someone and you've paid that for the full course, that I will make sure that you get some RSPs into your deal, whether it's coaching with what to say to those people, which is part of the course, but I'll spend some one-on-one time with you guys on the phone and helping you through the ins and outs to set up your first RSP mortgage. And it could be with someone else that you know, or I might have someone in my network that needs a deal to lend to. I'm constantly paying people off, and by giving this presentation, ultimately a lot of people come to me and they want to do deals with me, and if I don't have enough deals, I need to put it to somewhere arm's length. So if you guys are interested in the full feature study course, I can also set you up with that as well. Just come talk to myself or Rose in the back, and I'll get you set up for it. And then you can get some money into your deals, whether to refinance, buy. It's truly one of the most flexible things. There's no credit checks with an RSP mortgage. You just need an appraisal or a tax assessed value to set these up, just to make sure you're not going over 100%. Olympia Trust does some checks and balances, and there's sometimes they will not allow things to go forward because it's not in the best interest of the lender. They work for the lender, not for the borrower making the deal. So if you guys want to make sure that every time you submit your papers to Olympia Trust, I'll help you make sure that your deal will go through the first time. And that way you don't miss a possession date, you're not sweating when it comes down to the end of your deal. So come see me at the end tonight, and I'll be sure to get you into that full program, and we can talk one-on-one about getting some money into your deals too. All right? Thanks, John.
It is the end of the night, so if you gotta go, go ahead. But does anybody have any questions before we lose John? Any questions about?
Well, are you selling RSPs? Are you selling real, like, is this to buy a house for yourself, or is this to take your money and get 6% return, or both, or?
Both. So if you have money to lend in an RRSP and you're not getting the results you want, you can come talk to me, and we can look at whether doing a real estate deal makes sense or not, and whether you want to move your money to Olympia to do a deal. You cannot work with your own money in your own deal. So, and if you follow Robert Kiyosaki, he calls that lazy anyways, using your own money for a deal. You know, we can go out there. So many people are earning such crappy returns. They're earning 6 or less, or losing most people are earning 2 or 3 when I meet with them, when I see what their after fees are. Most people I talk to are 2, 3, maybe 4. That bank manager with 5 was like so proud of himself until I gave him 8. Now he's like,
Are you affiliated with Robert Kiyosaki?
No, I'm just-
Track thing was? Isn't
I'm
that
just,
his?
no, it's not.
Oh, it's not.
No.
I think
I've done presentations on the fast track stage, but I've never worked for them. I'm my own boss. I'm self-employed. I put real estate deals together just like everyone in this room is wanting to do or already doing. And so if you're doing a deal with me, you're doing a direct deal with me for a specific property, not for a portfolio, not for a share. You're actually getting backed by a physical asset.
yeah.
And so
That's great for us investing money into deals with our RSPs, but you'll also show, to clarify the question, you'll show us how to,
get somebody else's RSP into your deal.
right,
Because you can't use your own. So what I've just given you with the one that I'm going to give you over the next day, by tomorrow morning you'll have it, is you're going to learn exactly how to lend, and you can share that how to lend information with anyone who you want to lend to you, or if you want to lend yours out, that's fine too. If you really want to learn how to buy a place in the full, the Deal Maker edition, it's for somebody who actually wants to put a real estate deal, finance it using RSPs. So a deal I did a deal in Kelowna. I bought a $200,000 condo. We bought it for a bit less than that, about 180. We put a little bit of work into it. It appraises now at 250, and we have 200 owing on it. So I'm financed by 200 grand on it with an RSP. I went no bank qualifying, no down payment, and I now have a cash flowing condo down in Kelowna that's already rented out. And I did that again for one that we bought, fixed up, and I've already sold. And so if you want to learn how to be able to buy deals like that, I bought entire houses using RSPs. I bought a house with the first bank mortgage and a second mortgage. Like the one I'm buying tomorrow is 65% institutional financing and 35% of it's RSP. And together it makes up 100% of my financing for the deal. I pay my lawyer fees, which are probably going to be $3,800 to $4,100. They're a bit higher because there's a bit more work than a normal purchase.
You gotta
for a
go
lawyer to do.
do a little hustling and find some money if you want that.
I will give you.
But
I
there's
give you
a lot of frustrated RSP people, because even like CBC was saying last year already that it has been proven they're a horrible investment.
Yeah.
Yeah.
Well, it's the things people are investing them into, because an RSP is what an RSP, but what it's invested into, I find it limiting. Like when you can only do the GIC, like when you're limited to these things here, and the real estate is in the form of a mortgage. When you're limited in what you can put it into, you can't just put it in. Your friend wants to open a butcher shop next door and needs money, and you're going to invest with him because you trust him. You can't use your RSP money for that. So but if you had cash, you could. So there's a lot of people with RSPs. There's over $1.3 trillion in Canadian RSPs, and most of it's doing crap.
yeah.
And you and your deal can help somebody else do far better than they ever imagined, and you can get another property to add to your portfolio. When you're done paying your interest to that private mortgage, that's it. That's all you pay. It's not like a joint venture partner that you're 50-50. You're not giving a piece of the deal away.
And there's,
But you're paying a higher percentage than you would on a conventional mortgage.
One would think you can get them at 3.5% too. It just, the lender has to be open to it.
and Ivan, I think you said you're sitting on a lot of equity, right? So that's the situation I was in. I had this townhouse with a lot of equity, and hey, Sam, you don't have a job, or you don't have enough of you don't have, your debt service ratio is all screwed up because you co-signed your sister's mortgage on her house. So what did I do? I found a guy on one of the online real estate forums who loaned me 60 grand, and used that to go buy another townhouse on my existing equity. So yeah, and I've only, like, you've done way more of this than I have. I've done 2 or 3 of these types of things, but I'm certainly going to expand.
OPMs.
OPM, yeah. OPM.
Yeah. Well, I think this is an ultimate way to use OPM. I believe it's very safe and secure for a lender. Now, just because you can go to 100% doesn't mean you're going to. But it is flexible enough. If I have literally bought a place, 20% down, 80% bank financing, and the next month pulled my 20% down by putting a second mortgage on it and used that money to buy the neighboring house for the same price with the same down payment, and I've literally pulled it out and bought the next neighboring house and the next, to the point that I've got 10 places on the same street now.
But by pulling out, you mean you're replacing?
I used one down payment of cash. So those ones they were about 130 grand to put down. A $650,000 like legal 2-suite duplex property, and there was a whole bunch of them the same on the same street. They're owned by a builder, and I made a sweet deal with him. And so I used the down payment, the 130 grand once. So I went from 650 to owing 520. I cover these deals in the course. But I have 520 owing on a first mortgage. I now have another 130 grand owing at, actually those ones I got at 5%, which is not as common, but I did borrow those RSPs at 5% in that deal. And then I was able to get all 130 grand out of the property. So now I have a first and second mortgage to pay, and I made between $800 to $1,000 a month after paying the first and second on that deal.
So how are you satisfying the banks with where the money is coming from to pay these these mortgages, right?
It comes from the renters.
But I thought
pay
they
their
don't count that anymore. Like, I've been trying to get funding, and they keep telling me that I have to be able to cover all my mortgages with my own job, negating all rent that I bring in.
And so that's a deal that I did with a joint venture partner.
That's the one you're closing, right?
Well, like I said,
Tomorrow.
today was a success of mine because I got my own financing. I got institutional so for the last 5 years, what have I done? You got a job, let's get a place together. You got a job, let's get a place together.
So you're using other people.
Yeah. Oh, you're young and not a lot of debt, and you got a good oil sands paying job. Because remember, I have good contacts up there. You want to get some mortgages with me? I'll supply the down payments. You put no money and just get the mortgage. Sit back, I'll do the rest. You can get a piece of this. Not the whole thing, because I'm still pulling all the strings. But whoever partners with me will get a piece, and then at the end of the day, they'll have a first and a second mortgage in their name. And then I will have my down payment money back, ready to use again, to pull it out again, to use it again, to pull it out again. To use. That's the article I wrote in Canadian Real Estate Wealth magazine, was the story of 5 of those properties on that one
right?
street.
A year ago.
Yeah,
It's
and-
changed quite a bit in a year.
Well, with these RSP mortgages, the mortgage lending rules don't apply.
Because who's the lender? It's not
private.
Yeah.
Ryan and I known each
But
other
so-
for a while, and Ryan trusts my experience in real estate, so he's comfortable lending to me in our example that we role played. So he's comfortable with it. He can ask to see my credit check, but it's not mandatory. He might, as a lender, feel more comfortable in me because, let's face it, we met once. But if he's gotten to know me over time and seen what I can do in properties, he would know that I'd be good. Same thing for you. You've got a couple properties on the go and you seem like you're maxing out. And that happens. That's why I'm excited. After 5 years of being maxed out, I got more financing.
Yeah, that's like they only let me grow in equity, but they won't let me grow.
Yeah, but I didn't let that stop me. I had no job and was still able to go get more of these. There's no limits. You're only limited by the number of good deals you have or can find, or equity that's in your properties. And you're limited by the amount of people who you can have this conversation with. And in that course, I teach you exactly I have like word for word, when you sit down and have a coffee with someone for an hour, I have word for word exactly what to say in what order, so that it clicks in their head that it's a good idea for them to move their money from wherever they're banking to Olympia to do one of these deals. And I also cover, I now have a 10th, which I'll add to the course, but in the course right now, there's 9 different deal styles that I use RSPs for.
John,
Some are fix and flip, 3 of them are rent to owns, some of them are buy and holds, some of them are outright purchases, like that condo in Kelowna deal where we just bought the whole thing with no banks. And so those are all covered in the, if you want to be putting these deals together, then this is the thing for you. If you're just getting started and can still qualify at the bank and stuff, maybe something like this later. Now, I enjoy teaching this stuff, but my bread and butter in my business comes from doing deals with other people's RSPs, not just selling courses. But if you're actually gonna work on the course, I'm there to help you with it. I've done it a lot of times. I like seeing other people succeed. I do. So if you wanna learn in great detail, then this is what you need, and you can come talk to me about it, and we'll be communicating throughout the course so that I make sure you get a deal, because the next thing I want is next time Sam invites me to come back here, maybe he'll ask me to talk about rent owns, which is my other like good trick that I do in terms of real estate. And I want the next time I come back to see you guys, for some of you guys to have done some RSP mortgages, because they take, once you learn it and you get it and you get the person to want to do it, it literally takes 5 minutes of emailing your lawyer. There's a little follow-up calling, hey, did you get the papers? Can you sign them? But it's really easy. Like for tomorrow, one of my lenders, tomorrow, this will literally be her 10th RSP mortgage with me.
Yeah.
Actually, it's the husband's RSP, but the wife makes all the decisions.
Isn't that typical?
Well, I have to, hey, can you get Gary to sign that paper? I sent it to your email, right? But I know them both, and they'll have 3 on the go with me at the moment, because they have a big enough RSP account to do 3 deals. And this one for tomorrow, they're only doing a piece of it.
Yeah.
They're doing like a small piece of it. The other ones they've got bigger pieces of. But there's ways to work where if you have 100 grand and you have 180 grand, or you have 80 and you have 100, and I need 180 to go buy that condo in Kelowna, I can combine both of you guys together and still do my deal. So you don't necessarily need one deep-pocketed RSP lender. You can find 4 or 5 little guys and do it. The one for tomorrow is actually made up of 5 different accounts between 4 people.
Wow.
There's a husband and wife, they each have an RSP. The husband has a LIRA as well from an old job that he used to work that we can work with exactly the same way. And then I have that bank manager, he's putting in a little bit of money. He's gonna try it. So I put him in a short deal because I want him to get paid out so that he brings the rest of his money to work with me. I want him to have a good experience, not a 5-year deal where then he decides to come with me. I want him in a short one. So I put him in that one. And I have that woman and husband, well, the husband who's done, literally this will be their 10th one with me. And so once they start doing it, they never really want their money back. They want it growing. So, and they want it growing at these rates, and they want it secure.
All they have to do is the one and they see it, the benefit of it.
As soon as it clicks, just, they look at their statements, they can compare, if they still have their old account, and they look at the 2, people come over, they are free, when one deal pays them out, they get paid out in full, and it's their decision to come to the next. They always get paid out in full. So there's no like Ponzi. If the asset is sold or you just decide to pay it off, their money goes back in their account. And it's their choice to do another one. And if they want to go back to, if that bank manager doesn't have a good experience or just changes his mind or something, then when this deal is done, he could choose not to work with me and put his money back, transfer it back over to his Royal Bank.
What's your average investment you receive from the RSP?
Do you have a minimum?
A minimum, usually about $25,000 and up, because you need, when you're working on something, it depends a little bit what the deal needs. So if I do, because it costs a bit more lawyer, like I'm gonna have a bill somewhere between $3,800 and $4,100 with my lawyer for doing this, the purchase and the RSPs on it. So it's gonna be about $4,000 instead of what might have been about $1,500 to $2,000 to do the same amount of lawyer work to purchase it normally. So if it costs me about $2,000 more to borrow that money, now I'm borrowing $193,000 as a second mortgage. So for me, paying an extra $2,000 to have this all set up, no problem. But if I'm gonna pay $2,000 to borrow $20,000, and I still need to pay the $20,000 back and interest on top of it, it starts being less appealing for someone who's a deal maker who's putting these deals together, the cost of borrowing just gets too high. You can't make business sense. If the deal can't pay for it, I don't wanna do it.
So, one last question, we're over time, so go ahead, Bernard.
Do you usually always get everyone in at 100% loan to value?
No.
Okay, I was gonna say.
I'm just
you know,
saying.
I was like, I want those investors if you wanna share them. But
Yeah.
then the other thing I was gonna ask you is, you know, if you have 4 different people biting it off, do you have, like, who's in priority for second? Or
They
do
can
you-
all be put in the same position.
In the same position.
So in the
Regardless
deal,
of their-
yeah, so the 4 people with the 5 different accounts, including RSP and Lira, are all being put in second position.
And there's no first position.
Well, there is some institutional lending.
Oh,
The
okay.
65%
Right.
And do you always-
first mortgage is, you know, I qualified for that, so I took it.
Yep.
That's-
Yeah, exactly.
And like then the institution was fine that the 35% was from RSP?
Yeah, well, at first they had approved me, and I said, I wanna make sure that you're, because normally if you're using cash, they don't care. And a month later, you can pull it out, and they never know any different. But at the time of purchase, you do have to tell them. And so when I did tell them, I said, I had two people fighting over me to do the first mortgage, and so I said, I'm putting a second on here at the time of purchase. And so the 2 of them that were fighting over me and lowering their rates, they were lowering them, trying to be competitive with each other, so I would borrow from them. They want to lend to me. And so then we got down to a certain point, and I was like, well, that's even lower than, and I like quite a bit lower than I crunched my numbers of what I need this deal to be under. So I said, that's great to me, I'll take it. I said, by the way, do you know I want to make sure you're clear, there's a second mortgage going on here. And they looked at it, they said, we want the details of the second mortgage, we want to know the amounts, repayment frequency, they wanted to know everything. And they wanted to see the commitment letter, so I had to draw up a commitment letter for that, and get every person to sign that I knew, and they all did. And so then the first mortgage lender said, we want an extra % because you're putting a second on there. And it was still below what I calculated. I said, sure, that's fine. I wasn't gonna say no. I'll pay an extra 1% for that money, you know, for $350,000. Sure.
So
So your total loan to value on that condo was?
Well, this is a house for $550 that we're buying with $357 first,
Yeah.
and $193 second.
okay,
So, but that's one that's in, you know, it's a $550,000 ugly duckling house in a neighborhood that homes sell for 1.4 to 1.7 million. This is going to be an infill in a very busy area in Ontario. And so we've literally got the ugly duckling, and everyone's like, okay, John, we're fine. You're gonna put even more additional money into this, where to the point where it will not be 100%, it'll be 100% loan to value at the time of purchase.
That's right.
But give it a couple months' time, it's no longer gonna be 100%.
And you showed the appraisal with the as-is value and the as-complete, exactly.
Yeah, exactly, and everyone was like, I told them all my plan, what I'm using the money for, I plan to pay them back. And, well, the husband and wife and the other wife that does all the decision-making for the husband, they've done this with me several times and been paid back several times, so they were pretty much like, we're in, we're good. Like, I called them when I had an offer on the condo, the deal that they were in a Kelowna condo deal that sold, the flip.
Yeah.
And I called them in September, I said, I'm working on this deal for the end of November, I'm not done my due diligence yet. So, but I wanna let you know, good news, you're likely to get paid out in October. We have an offer, and we're conditional on the offer on the condo, so it looks like the condo's gonna sell, which means that your money's gonna get all paid back to your account. Now, I haven't, and for me, there's a scarcity, there's a limited number of deals I can make versus the amount of people that wanna lend to me. I have a large amount of people that lend to me and want to. And so I have a database of about 450, almost 500 people that I can blast an email out to. This is what I'm offering, and usually in an hour or less, I've funded my deal, either cash or RSPs in this way. Whatever I'm looking for, I put it out there. So whenever I phone someone, I'm gonna pay them off, I say, well, If you don't want in, no problem. You're free to do whatever you want with your money. It's your money. But if you do want in, I won't bother emailing my network. This one's for you. I'm holding it for you, and I'm counting on you to go in it. And then a little bit later, congratulations, the condo sold, you've been paid out. After that, you know, my due diligence, my appraisals are done and stuff of the house I'm buying. So the deal that I told you about before is good. Do you want in on it? And they all said yes. Everybody who got paid out wanted in on the next one. Because if not, their money sits there doing nothing.
I was doing a little bit.
Well, not when it just sits in the Olympia account. I think they pay a small amount. I think it goes a little negative when it sits because of the like $10 a month account fee, right? So
Yeah.
But that's a lot of how it works, and so there's a lot of great details about like the lending side and the borrowing side. I go into hours of the finite, like different scenarios in that course. I go through exactly what do you need to do to say to someone over the course of an hour-long coffee meeting to be able to get them to come into your deal. I cover obstacles that you might encounter along the way in your conversation, how to handle those objections. I mean, it's not for everyone. You're not going to pressure them to come in, but you want to educate them enough so they're willing to make a change in their financial future. And I'm going to teach you how to present your deal to them. And then I made another little bonus section, a final section, where I showed 9 different real life deals with the real numbers, with bank statements, the deals that I've done that are not just buy at 100%, buy at 100%, I change it up. This one's buy at 100%. This one's buy it, pull the money out. This one, each of those 9 styles of deals are completely different uses of these RSP mortgages. The RSP mortgages are very extremely flexible in what you can do, but there are rules in what you can and can't do. When you learn the rules, and they're easy to work within, but there are certain do's and don'ts. After you've figured out what the do's and don'ts are, you can let your creativity go. And there's excellent ways you can do flips with this. Can you imagine buying a place, no down payment, you're gonna put work into it, you're gonna put some extra money in from somewhere, but if you could buy a place, have no payments for the whole first year, put some money into, so now you're not having an empty place that you're making payments on every month. That doesn't feel good. You can pay for that at the end of the deal. So if you guys want to learn those details, then it's going to take a little bit of study and a little bit of time, and I'm willing to come there and help you out with it, answer all your questions, and help you, coach you a little bit. When you're meeting with someone, if it doesn't go well, call me afterwards. Tell me what happened. We'll troubleshoot it, so the next person you sit down with, you get a yes. Typically, most people say yes to me when they sit down to do these. And I believe it's a superior way to grow your RSP. I do it myself. I really do believe it. So, you know, if you want to have the same tools to teach to them, then come see me and I'll set you up with that course. All right?
Thank you, John.
Thank you.
That was fantastic.